Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Andrew Beer and Tom Robel and myself, Niels Kaastrup Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Andrew and Tom, it's great to have you both here. It's been a while, but how are you doing? Tom, I'll start with you. I know you were traveling last night, so you must have
very well, thanks,
stories.
Niels. Very well. I was in Sweden, and it was interesting to see how attitudes to hedge funds seem to be slowly shifting maybe there.
I'm sure we'll talk about that. And yourself, Andrew, how are you doing?
Things are good. Excuse me. Sorry, we had a great year-end, multi-person session, and it'll be very interesting to talk about things that have happened in just the past 6 weeks, which seems like it's been about 6 months of activity.
I know, it's crazy. Anyway, we've got actually pretty strong lineup of various topics. As you said, some of that will be inspired from what we talked about in the group conversations, and maybe also some new stuff that we normally don't talk so much about in this specific series. But of course, as we always do, I'm always curious to know kind of what's been on your radar, what's caught your attention the last few weeks. I'm going to kick it off with you, Andrew. Anything in particular that you've been noticing?
Well, I mean, I think look, it's not an original topic at all. I'm totally fascinated with AI and how the narrative around it is shifting. Some recent things and just in terms of both the power of it, but also the pace at which things are changing. I'm not an expert at it all, and I'm sort of realizing that part of what I need to be thinking about more actively in terms of myself and our strategy as a business is really where AI fits into it as it's evolving. Now, fortunately, I have a couple of partners who are extraordinarily capable at it, so it's not that we're not focused on it. But there was something interesting that happened recently where our PR firm, usually I'm very, very involved in anything that we do that goes out into the public domain. And while I was very distracted in other things in December, they basically took podcasts of mine as well as material that we had done and did a killer 2-minute video that is, I'll release in the next day or two, that basically, but it's my voice, but it's my AI generated voice. The content is incredible by people who really are not experts in this field. So it sort of encapsulated that there's something very, very profound in this. So, watching what's happening in the markets and how people are trying to figure this out, I think it's going to be disruption galore. And I believe that is actually going to be very, very positive for trend following, because we need real economic change to make money.
As long as you promise there's always going to be the real Andrew that shows up on the podcast and not the AI Andrew.
So my theory is that it actually that people who actually have human connections to other people in this, like the asset management business is a people business. I don't think asset allocators are going to say, you know what, let's have AI pick the next hedge fund for me. I think it's too risky, and honestly it takes all the fun out of the business. So I think understanding the ways in which it can be leveraged. I think this is what everyone's going to be thinking about for the next 20 years, and seeing it happen in real time is just, endlessly fascinating.
It's interesting. Just before we hit record, I asked Tom if he was going to the iConnections conference in Miami in a couple of weeks. And both Tom and I will be there. So of course, if anybody's listening and they have a lot of money to allocate, they should definitely reach out to us in the app. But having said that, it kind of is interesting with what you say, because here you have probably the largest conference where you put together 5,000 people or whatever the number is in one convention center for for 2 or 3 days. And so you can either say AI is going to either completely change that and nobody really needs to go to these events, or it's going to strengthen it and say, no, as you say, Andrew, no, we do need the personal connections. We do need to sit down physically and talk and so on and so forth. Very hard to tell at this stage.
Yeah, I mean, one of my favorite investors sent me something they'd done last night where they basically used AI to do a whole asset allocation analysis. And he said it took him about 15 minutes. And the results are pretty astonishing. And one thing that was actually kind of encouraging about it is that it actually did say, all right, if you want to achieve these investment objectives, it brought managed futures as one of the core elements of doing that. So, so there's a way in which the promulgation of this kind of technology and knowledge will also, help the average allocator to be more sophisticated about the space, to cut through a lot of the noise in the space, which is what I think you and your guests do incredibly well. And so I mean, look, everything's going to be what's the the only constant is change.
Yeah.
And seeing how it plays out in all the various manifestations, I think it's just incredibly interesting. So.
I don't think it's the same investor, but I have a client as well who's AI savvy, and he sent me something like a couple of months ago where he had given 2 or 3 different AI platforms kind of a question about asset allocation for the next 5-7 years, based on the fact that he was based in Switzerland and this is what he was looking for. And as you say, not necessarily specifically mentioning any strategies as far as I remember. And that also came back with a fairly large allocation to trend following. So the information must be out there since they're picking up on it. So that's interesting.
My one-line response after reading his analysis was super intelligence is here, because I like the conclusion.
Anyways, Tom, I mentioned that you'd been traveling. Not sure that that's what's really been on your radar, but what has been on your radar the last few weeks?
Yeah, it's really been many discussions with investors and managers around the shift away from the US dollar and from the US in general. I think global markets really did change in 2025, and the perception with investors is that the period of US exceptionalism is maybe over. I mean, in April, Liberation Day really hit markets, but we did end up with a fantastic recovery in 2025. The S&P ended up 16%. But was the conclusion that the US has won at capitalism? I think for a US investor based in US dollars, that's a fair enough conclusion. But for the rest of the world, you can't go back to the same state where American assets are all that matters. I think the risk in the US is perceived as potentially higher than it was previously. And the rest of the world is now clearly looking at the country's markets through an entirely different lens. Normally you have non-American investors can rely on the US dollar to rise in times of stress, and the US dollar has enjoyed the status of being a safe haven currency for assets. But for non-domestic investors in 2025, the weakening of the US dollar meant that actually a euro investor with the same S&P 500 investment was up just 2.5% last year, and actually potentially negative for other indices. So I don't think investors are necessarily looking to sell American investments or avoid them entirely. It's just a rethinking of what assets investors are holding and a real kind of analysis of US risk and how they choose to engage with that risk.
As a completely selfish observation, here in Switzerland, the Swiss National Bank distributes some of its profits every year, I think, to all the cantons. And of course, it is well known for having huge investments in the US tech stocks and so on and so forth. So I hope someone, is listening and maybe reconsidering that strategy if you're right, Tom.
Well, there's two things to think about. I mean, I think there's a very valid argument that global equity markets don't have the capacity for a wholesale shift in investor assets away from the US. But there's definitely a thought about outside of tech, what is the sort of asset that we're accessing in the US, and can we get it elsewhere?
Yeah. Well, we're going to talk a little bit about that. I know Andrew has some topics on that. But I am on my radar, a few things that caught my attention. But the first thing is more a question for you. and that is, of course, we are in the middle of the Winter Olympics. So I'm curious to know if you have like a favorite sport that you're watching or that you want to make sure you are going to watch in the next couple of weeks.
So, I've gotten very down on the Olympics in that, one is I don't think you should have 37 sports at 37 events per sport. I sort of grew up in an era when the Olympics was special because you had people who were, toiling as waiters at ski lodges, and that yet were finding 6 hours a day to ski and to kind of compete at the international level. There was something very this was their moment, right? Every 4 years, you had this opportunity to become a Mark Spitz or a Bruce Jenner or somebody who goes from total obscurity to becoming kind of a national hero. The American hockey team in 1980. And, it's a little bit like in U.S. sports where they've added more and more playoffs because they're very, very high generative. And here I was at the gym this morning and watching, some snowboarding competition, but it could be snowboarding, slash V1, whatever, like some subset. And then also with the barrage of promotion around individual athletes and the elevation of them, to me, it's just lost a lot of its the special quality to it. But that's going to make me sound incredibly old and cranky.
What about you, Tom?
Well, in the UK, we don't have many snowy mountains or frozen lakes, so for us, it still has that special element, I think. I'm definitely following the curling. The curling is quite interesting. All the curling stones are still made in Scotland, so it's very exciting. And we seem to be very, very good at the luge and the sliding events. So we're definitely following that. But you're right, Andrew. There's never been a time for interest in niche sports as around an Olympics.
I hate to break it to you, but actually one of the things that caught my attention that I'm really looking forward to is actually one of the new sports at the Winter Olympics. They call it skimo, but it's actually ski mountaineering, where they first have to climb the mountain before they ski down. I'm very excited to see what that is going to be like. That seems like a fun thing to do, but in general, I kind of know what you're getting at, Andrew, in terms of too many things doing the same. Anyways, more interesting from a financial point of view, something that caught my attention. I don't know if you saw this, but Google has issued 100-year bonds, I think, this week. I thought that's kind of interesting. I mean, I don't know what that tells us about their expectation to interest rates if they're issuing 100-year bonds at these levels. But that apparently has not happened since 1997, where Motorola issued a 100-year bond. So that is pretty rare. And then the other thing that caught my attention, I kind of quickly shared it with you, a little bit unfair because it was with short notice. But it's just this email that I received from Dan Rasmussen over at Verdad. And I don't know Dan at all, but I know he's involved in kind of the private equity world. But he was writing an article or an email about sort of some of the differences between hedge funds and private equity. And the heading was why hedge funds got better while private equity just got bigger. And I think there is some interesting aspects to that observation for sure. My key takeaway, and feel free to weigh in here, but my key takeaway was, if I remember correctly, that hedge funds, in his view, simply had to improve because of the competition and the attention that private equity was given by investors for so long. And to a large extent, maybe operating in liquid markets with mark-to-market and all of those things that we do in the liquid alt space for sure, basically meant that they became better managers, better structures, better processes, et cetera. And I think that's kind of an interesting observation. I don't know if you agree with it or have another take. Andrew?
Well, I think from our side, I think we see renewed interest in hedge funds kind of across the board. And part of it is people got out over their skis, to use an Olympic analogy, in their exposure to private equity. And the way people often would do it was that they would overcommit to it with the expectation that they would get money back in a certain period of time. And so the fact that kind of the money coming back didn't really materialize while they still had the commitment outstanding meant a lot of allocators were simply had too much exposure to it. And that's also driven kind of the secondaries market. I think when you're in a persistently long bull market, also the fact that, and look, Dan has done great research on the return characteristics of private equity, essentially being some version of leverage equity with, the wonderful feature that, you could pretend that you don't have to mark things to market. But I think now when people are thinking about, all right, where equity market valuations are and what the expected returns over the next 10 years and leverage on top of it and being, up to their gills in things like software stocks that could be disrupted, maybe having long-term leverage, long equity exposure is not as attractive as it used to be. And in a world where the macro environment is shifting, back to Tom's point about this migration, I wouldn't say it's like a wholesale migration out of U.S. assets. I would say that the attitude used to be FOMO about the U.S. markets, and now has kind of people saying like, well, wait a second, this used to be the global bastion of rule of law around business activity in terms of predictability, and clearly things have changed. So I think in the context of that, you think who has the ability to make money on a going forward basis, and then you point to the hedge fund industry, which has done, certain hedge funds have done astonishingly well in this environment. And so that's drawing attention back to it, which ultimately I think will be good for all of us.
Yeah. Do you come across private equity a lot, Tom?
It's something we come across as discussions with investors because it's part of their alternatives portfolio. It's part of the portfolio allocation. And I think you're right. It's become a big part of what investors do. But we've been in an unbelievable environment for 15 years, more than 15 years. And is that environment going to persist for equities? We don't know. But I think when I was last on the podcast, we were talking about the macro environment for, let's just sort of call it sort of global macro hedge funds. So a hedge fund that can go into any asset class, deploy assets long, short, in a relative value kind of perspective, and take advantage of any kind of inefficiency. We are, that environment for hedge funds is only gotten better. We've got stubborn inflation. We've got geopolitical dislocations and tensions. We've got commodities bursting back onto the scene, an asset class which has been underappreciated with compressed volatility for a long, long time. And we've got interest rates still relatively low, but higher than they've been for a long period. And it just looks like a very interesting time for tactical trading strategies that can deploy assets across markets, long and short.
Yeah, no, we'll dig into that some more. Let me just quickly run through where we are on the scoreboard, so to speak. My own trend barometer finished yesterday at 50, and that's still a pretty productive environment for trend following. And it has, more importantly, been very consistent the last few weeks, as data also will be supporting. These numbers are as of Tuesday of this week, and the beta 50 is up 1.48 in February, up 6.58 for the year. The SocGen CTA index up 1.25 for the month, and up 6% or so for the year. SocGen Trend Index up 1.65% for the month, up 6.43% for the year. And the SocGen Short-Term Traders Index up about 0.5% so far in February, up 2.78% so far this year. And in the traditional world, MSCI World up 94 basis points in February, up 3.22% so far this year. The S&P US Aggregate Bond Index up 41 basis points in Feb, and up 60 basis points in 2026. And finally, S&P 500 is pretty flat for Feb, up 1.5% so far this year. I was wondering, before we go a step back a little bit, and maybe we talk a little bit about your own review, Tom, that you put out in the last day or two, this more comprehensive look at 2025. But I wanted to also ask you a little bit, and of course, Andrew, you can jump in as well, about the first 6-7 weeks so far this year. Obviously been very constructive, clearly continuing where we left off in 2025. Is there something about the new year that you're noticing, Tom, that you find particularly interesting, or anything?
Well, I think understanding 2025 performance and the second half of the year in particular does help us understand what the beginning of 2026 looks like. Because one of the conclusions we came to when we were writing and analyzing what happened last year was that performance and opportunities for trend following came from a really kind of diverse number of markets. We obviously saw standout performance from metals, and precious metals again this year have been a key performance driver. But it wasn't just metals, and it's interesting hearing about your trend barometer, because we run a similar exercise where we calculate breakout models over almost, I think, 200 or 500 different parameters, from very short term to super long term, across all different markets that are sort of potentially tradable by CTAs. And on average, last year, the Z scores, so the opportunity sets, is similar to your kind of barometer, I think, was pretty poor. So last year, your selection of asset classes and the way you allocated risk and managed risk was really, really important, because there weren't opportunities broadly across all equity markets and all currencies and all bonds. In fact, bonds was really poor last year. So what we've seen, I think, this year is a continuation of that theme, where we've got really important market trends, and if you're not trading those markets, you're going to be missing out on something. So I think last year, for the second year in a row, commodities was one of the key performance drivers, and 2024 was very similar, but it wasn't coming from the same place. In 2024, we saw trends in the soft commodities, so cocoa, coffee, as well as precious metals. In 2025, it's really been the precious metals that have been the key performance drivers. And if you weren't trading them, as I said, then that wasn't available to you. But also, there were some really, really strong trends in other markets. And that's again continued this year. So for this year, in our trend indicator, we're seeing really good trending markets in KOSPI, Nikkei, the Swedish OMX, and IBEX 35. So these are sort of smaller European equity indices often that aren't necessarily the go-to financial markets that people are looking at.
It's funny you say this thing about, if you weren't trading all these markets like the softs and some of the other metals, you would be missing out. But not if your name is Andrew, because he does not trade them, but he did not miss out last year. That's all I can say. But let's stay with this year, and then we'll maybe dive a little bit deeper into your report, Tom. But any thoughts from your side, Andrew, for this year?
CTAs generate alpha when they're early, contrarian, and right. Okay. The second half of last year, they were dialing up equity risk after Liberation Day. They were holding their gold position. They were, so basically, from our perspective, you look at last year, it's gold and equities, and predominantly non-U.S. equities, and it was either maintaining that exposure after Liberation Day. Now, human strategists after Liberation Day were really rattled and really wrong, in that we were, the inflation is going to come soaring back. We're going to go to a deep recession. I think Bill Ackman used the term self-inflicted, nuclear economic annihilation or something like that. I mean, it was people really thought. And this is, again, the enormous advantage of CTAs is they don't care if as long as they see it kind of bouncing off the lows and however they end up measuring it, or continuing a trend. And I think that's continued into this year. I think it's I think there's an arbitrary end date at December 31, but it's been, look, we started talking about a rotation to non-US equities. People have been talking about a fundamentally driven rotation into non-US equities for 15 years, and it hasn't worked. It's consistently underperformed U.S. equities, but it's been happening for the past couple of years, and I think it goes back to the risk premium issue that we talked about. And on gold, gold was a failed trade for a decade and a half. It worked really well for a period of time. You had a lot of very, very smart people in 2010 expecting this profligate monetary policy to drive up gold. It didn't for a very, very long time, and while most people had essentially abandoned the trade, look, in 2022, gold didn't go up, right? I mean, that was the moment everyone was waiting for in gold. Inflation's going to come back and gold is going to pay off, and gold didn't go up in 2022. And then it starts soaring in 2024 for very, very different reasons. So I don't think it's complicated. I think it's non-US equities. I think it's in emerging markets versus US equities. And I think it's gold which encapsulates the whole metals complex. So.
Yeah. I mean, it's been interesting for me to see, for example, and I know this is early days, right? But clearly the momentum in some of the key markets from 2025 spilled over to 2026. So in January, definitely the same themes in terms of leaders and, of course, precious metals. Despite a massive sell-off the last day of the month, still came out ahead for most managers, I'm sure. But the leadership has changed a little bit in February. It's not so much metals anymore. We seem to be shifting more towards equities in certain parts of the world, as you rightly pointed out. Nat gas has been more productive for sure, and even some of the currencies are starting to support, which it doesn't happen that often. But yeah, so that's been kind of interesting for me to see. Now, Tom, I wanted to give you the chance to, if there were more, because it's a pretty comprehensive paper you just published. So if you want to dig out some more of those things that you felt was really important, I know we will talk about some of the topics as well, because we will dive into, I think Andrew had sort of specifically gold, silver, and some specific markets to talk about. But is there anything that stood out when you wrote the report, you thought, wow, that actually did surprise me a bit? Because, and let me frame that, if you missed the last couple of episodes of this podcast, Tom, what I've said to people when I've been speaking with them in the first few weeks of this year was that in many respects, I think we can all agree that last year was very unusual. We can say that about almost every year, but last year was another unexpected set of events that we saw. Yet, from a trend following perspective, it was a very familiar year. Few markets did all the heavy lifting. Then you had a few markets that lost a little bit of money, and you had a lot that didn't move much either or. So from a trend following perspective, I mean, if you didn't know what took place during the year, you would just say, yeah, just another trend following year. Maybe a little bit on the low side. Okay, fair. But yeah.
Yeah, I completely agree. And I think that's why the conclusion that we came to of the allocation of risk was so important. Normally we see some sort of speed factor, and I think Katie Kaminsky's done some really interesting analysis on the speed factor in previous years. And we normally see a much stronger preference for longer term models outperforming, but it's the classic sort of a contradiction about how you marry your investors who maybe can't always look at the performance with such a long-term lens versus the performance of models there where you can sort of show systematically that being longer term and into longer term trends does pay off. So it's really the allocation of risk last year that was the key thing, and how you managed that risk. And then, we were monitoring performance this year as those trends continued. I think the trend index peaked at 7%. Is, as you correctly said, it's now at 6.5%. But the range of the individual manager returns is still pretty same. So I think the best trend followers are up about nearly 15%, and still there are some up nearly that amount. I think that's on a slightly higher volatility target than many, but we still got many managers in that 10 to 15% range, and many just hovering just below the 10% in sort of 8 or 9%. So CTAs have definitely allocated risk and managed risk very well. If you want to see what an unrisk managed approach to trend following looks like, please ask us for the data on the SG trend indicator, which is our hypothetical model-based portfolio, which with very limited risk management. And you'll see some very interesting swings in the precious metals markets. But I think, in general, a couple of weeks ago, many CTAs were down a small amount, but they had a laser focus on risk. So not only allocation of risk, but managing of positions. Silver has caught a lot of headlines, but it's not as big a market as gold. And so maybe the allocation of risk to that market wasn't as big as many people might assume. And there was definitely a close monitoring of what the risk looks like in that market. So we've had CTAs kind of building proprietary models over the years to help them work out when trends are overextended, when trends are reversing. And I really think there was a looking at trend strength and looking at are these breakouts really supportable? And I don't think CTAs has had as much risk to precious metals as you might think. I looked at a CTA report today, and there was a much bigger allocation of VAR to equities and FX.
Yeah, no, I mean, we can dive into that. I know there was one of Andrew's topics, actually. We can jump around a little bit if we want to stay on sort of the theme of gold and silver and how these were traded. I know you had some questions about this, Andrew.
So yeah, I mean, Tom, I think sort of answered the point about. So look, I mean, you look at 2025, right, and gold is up 60%, right? I mean, this should have been a banner year for the space, right? Equities were up a lot, right? So you had very, very, very distinct trends, and it's continued into this year, obviously, and yet the space was flat, right? And in Tom's analysis, which mirrors what Nick Baltus was talking about in year end, and Katie has talked similarly, was short-term models really detracted from performance last year. And Tom's report, which everyone should read, has a great analysis basically on a factor by factor and using his trend indicator. But you're up 20% or something in long-term trend according to that, and you're down 12, 13, 14, 15 in short-term trend. Again, as we've looked at the space and we've looked at the shorter term models, we just don't see really positive Sharpe ratios in it. They sound great, right? They sound, but our view is they're a risk management tool, and they're often a costly risk management tool. If you're going to allocate a meaningful amount of money to something that has a zero Sharpe ratio over time, drives up your trading costs, it creates all sorts of other issues. So I think that's sort of the hard narrative part about the space right now is it feels like things are trending like crazy. So why isn't the space doing better? This year they are, but last year it was also getting, it was making money in our side, it was making money in gold and non-US equities, was about half the performance each. And then you got whipsawed and hope you didn't lose too much money in rates and currencies.
I mean, I think last year, if we just stick with that for a little bit, you're absolutely right. When people look at the year, they will say, well, hang on, equities were up a lot, so why didn't trend followers make more money in equities? It was very select equities that we could make money in because it really was all about the April deleveraging thanks to Liberation Day. So if you're, obviously you execute once a week, so you have a different way of interpreting what happened. Managers who are much more frequent, of course, we have a different way of interpreting. So I do think that for sure, the fact that we had to delever the equity long side for a while, and I think maybe some managers even got short at that stage, that obviously would have cost some. So I agree with that, but people obviously need to understand the way we got to the strong equity year wasn't in a straight line. Where it was in a straight line, as you rightly said, is in the metals, and I think most people made most of their profits in metals or some select equities. A couple of them also in the, say, short JGBs and so on and so forth. What is most puzzling to me, and this may not be very popular with some of my friends, but I'll venture into it anyways. In a sense, you're kind of right, because we have the discussion about being a classic trend follower where you don't adjust your positions and being kind of maybe a more modern trend follower where we do adjust our positions all the time. And so last year, which may come as a surprise to people, even though we made most money in precious metals, we were selling precious metals all year, right? So our largest exposure was a long time ago in precious metals. And then you could say, well, that's not great. When the trend is so strong, you should just have stayed with it. You would have made a killing. And there were one or two that probably did exactly that. But of course, we also know they kind of had a huge surprise on the last day of January. And had that day, for example, continued on the Monday with the same velocity, instead of a rebound, some of those managers could have been in real trouble, in my estimation of how it took place. Because some managers will, when you get a big drawdown, like in silver and gold prices on Friday the 29th or 30th, whenever it was, you may trigger your signal, you may trigger your stop, but you may not execute that trade until the next day. So had the next day been down another 20%, things would have been different. But for the larger managers who don't have static position size, we were just basically reducing our risk along with volatility expanding. So yes, you could say it's a little bit of a shame when you have 2 or 3 markets that really move strongly that we didn't make more money. But on the other hand, from what I can tell, and this is by no means any criticism, it's just an observation, but I do see many managers who are, or not many, but there's a handful of managers who talk about this, oh, you should never touch your position size, you should just stick with it, and that's how you really capture these big outliers. But the problem is, their performance was not in any way, shape, or form better last year. And why is that? And I think it has to do with the fact that they often trade 300, 400, 500 markets, and therefore any one market, even if you don't touch your position size, becomes a very small risk allocation in reality. And that's always been my view, that it's not a wrong or right, it's just a difference. But if you really want to have punchy returns and make those 50, 60, 80% returns, yeah, then you actually have to have a fairly small set of markets, but then be very gutsy about your risk allocation and stick with it. But that opens up another set of risk issues.
Yeah, there's a London CTA manager who is very committed to trend following, very committed to commodities and trading a small number of markets and letting risk run. I think we all know who it is, but is the end product something that's palatable to investors when they have these pressures on them from an investment committee and they have strategic asset allocations that they have to follow? I think you end up creating something which is difficult to sell to investors when you have something like that.
Yeah, I mean, you don't need many investors. I mean, frankly, and I think that's what I like about the space is in the sense that if you have a certain profile you want to express, then you can probably find enough investors who will want to join you. It's just a different set of investors, but I agree with you on that, Tom.
Yeah,
but
it's something that comes up, and it came up this week, about the role that your hedge fund or your CTA is playing in the portfolio. And it's something that we've heard about this. We have as our core risk asset, equity risk, and we're trying to diversify that. These large asymmetric returns are really good, and trend following is really good at diversifying that. And so the investors' sort of continued fascination with multi-strat isn't necessarily meeting the requirements or the objective that CTA maybe does when you get these large moves and you want to have these asymmetric portfolio diversification.
Yeah. Any thoughts, Andrew?
Again, I think about the space very differently than most people in that I view it as an allocator. Right. And that's originally we got into space as an allocator, trying to figure out how do we love the signal of the space, but how do we access that in the most efficient, straightforward, liquid way that we can. To me, the alpha in the space is like I think about. I remember the moment in September of 2020 when we started shorting treasuries. And I remember the moment when we were starting buying gold, and we're buying gold well below 3,000. When we started shorting the yen around 105, 106, or something like that. Like those were really contrarian, really early calls, and because again, I sort of straddle this world and the world of people who are trying to make these judgments on a regular basis. I also, again, I started a commodity firm called Pinnacle Asset Management back in the 2000s, and it was a fundamentally driven commodity firm where you had guys who knew more about the, somebody like John Arnold knew more about the fixed price natural gas swap market than anybody ever in the history of planet Earth, then or now. And the way that they viewed CTAs was they waited for the day when some signal went off somewhere and CTAs were selling, because they were kind of straddling between being market makers and trying to think about, sort of the fundamental supply demand characteristics of the markets. And so to me, when I think about alpha in the CTA space as an allocator, what I care about is when they pick up something that, whether, as I said, early, contrarian, and right, and it's big, and you can make money in it. Like, how does that happen, right? So you've got an asset that's worth around 10, let's say, just assume it's sort of a basic model. There's a lot of noise around it, right? So just based upon sentiment or whatever, it'll go up to 11 and then back down to 9 and then back up to 11, back down to 9. And so the basic model is that when you have people with local knowledge of that market who are maybe sitting on trading desks or high frequency traders, whatever you want to call them, it's generally the smart money selling at 11, buying at 9. selling at 11, buying at 9. And the kind of the sentiment is driving these prices around, but with no change in fundamental value. The valuable trends for CTAs are when it's something's at 10, fair market value is 10, and then the information changes, something in the world changes, and fair market goes to 11. And the people with local knowledge like it more at 11 than they liked it at 10. And then it goes from 10 to 11 to 12. And the smart money likes it more at 12 than they liked it more at 11. That means the world is changing and that they know something about it. They have some special insight that the world is slowly adapting to this information and they think it's going to play out. And so when I think about what happened in 2020, 24, 25, and this year, and I think about longer term versus shorter term models, in a sense, the shorter term models are the ones that are going to get whipsawed violently when you have these changes in sentiment like we had last year, but there's no real change in the state of the world, right? Whereas the longer term models are the ones that say, you know what, this shift from, I know, I get it. Everybody with their investing committees basically has been talking about a shift out of US assets and out of US equities for a long time, but we can see it in the prices. And we can see people moving their money at the margin. And so we're going to get behind it, regardless of what we thought about things 6 months ago. So by that definition of alpha, short-term models detract value. It's not the exposure that I would want. And I think people have conflated risk management with if you're going to introduce something into your portfolio and allocate a lot of risk to something with a zero Sharpe ratio, no thanks, not for me.
I don't know if you remember, Andrew, did you manage to keep, because obviously you do things completely differently to an underlying manager, did you manage to keep a fairly static allocation to gold last year?
No, it bounced around. When we think about the variation between us and the hedge funds, there are kind of 4 drivers of variation, and we tended to get all of them right last year. In 2023, they all went against us, and we underperformed by 500 basis points. It can happen, but it's the only time it's ever happened to us. We outperformed a lot in 2024 and 2025. Slowness helped us last year, right? And if you look at our performance, so one is our performance around Liberation Day was much better than the index. And it was better for 2 things. One, I think your position 297, when your vol is spiking and you're de-risking after Liberation Day, I think you are making somebody's P&L in that local market. I think you are the amateur outsiders who somebody has pressed a button to sell it. And you're not executing the liquidity dries up in that market because they can see you coming. That's why you have all these things on Zero Hedge about what CTAs are doing. Now translate that into a market where you've built your career for the past 25 years trading that market every single day. Charlie McGarr, actually, from who runs Altus, which is the sub-advisor to Simplified CTA Hedge Fund, used to run the metals desk at Goldman. And he's talked a lot about this, that when you have that kind of local knowledge and you have systematic traders coming into the market, it's that's your P&L right there. So I think this diversification into a lot of excess positions, increasingly non-core positions, I think it hurt people after Liberation Day. It exacerbated the drawdowns. I think that's a market structure problem. That when you're building these models, you have to make certain assumptions about implementation costs. And I don't think most people factor in getting taken advantage of by local traders. And then the second was we still had some risk on. We were slow to de-risk and bounced when Trump changed his mind. So that kind of blows up the idea that actually having, and that now, I mean, in Tom's data, interestingly, really short-term models were fine during that. They actually preserved capital much better than longer-term guys during that initial period. It was actually later when they started to get chopped up. But again, so look, I think of it as an allocator, and I think back to the point that you and Tom have made, that the investor preferences are often to live in paralyzing fear about what a bad whipsaw looks like. And as you say, whether there's a bad Friday turns into a horrible Monday, which is what happened with SVB, right? And so it can happen. I just don't think you're paid for as an allocator. I think you lose too much. Like it's like saying, well, let's do a long-term trend model and then buy out of the money puts on equities because that's what we're afraid of. Fine, you're just not going to have a business after 5 years.
we got a few different topics, mainly from you, Andrew. So I'm gonna kind of defer to you. Which one you'd like to bring up? We talked about the gold and the silver. We tried to get into kind of a little bit more the nitty-gritty about how managers probably were different and how they handled this. Where would you like to go next?
Well, since I'm on a rant about product design, let's talk about the liquid alternative space. Okay. So the broader liquid alternative space, which means, hedge fund strategies, since we're talking about Dan's article. So hedge fund strategies in mutual funds and ETFs, and now increasing, mutual funds and UCITS funds, and increasingly in ETFs. It has been an astonishingly bad category. Like the ratio between intelligent people and serious firms who've launched products relative to the total utter lack of success from an investor perspective is pretty astonishing. You're talking about hundreds of products that have been launched. Each one, when they get launched, is somebody sitting there saying, we've got some great way of doing equity long short or market neutral or this or that. The returns over 15 years, according to Wilshire's data, is between 2 and 3%. And the fee structures, on average, is about 200 basis points. In a period of time when equity markets have gone up 14% a year over that period of time. So this is worse than throwing darts, right? I mean, if this was a sports team, you would be asking, are you throwing the game on purpose? It's horrendous. And I think I had this sort of epiphany last year as I was thinking about it, because we've only done a very, very small number of products over time because we've always had a view that like for us, if we launch a bad product, something that doesn't work, it's our reputation. It's a huge percentage of our time gets allocated to it. In fact, we ended up shutting products that we didn't think were scalable, even though they did fine from a performance perspective. But a typical firm has a huge distribution infrastructure to support, and they have no view on which is the best product that they're going to launch. There's no one who approaches this from an investment perspective. What would I want to own over the next 5 years, and how am I going to get that in the most efficient way? Actually, with actually one exception, which SCI hired us 10 years ago with that mandate to help them build a UCITS fund, where they basically said, can you find a way to construct an absolute return product with a beta of 0.2, cash plus 5 gross, and all-in expense ratio less than 100 basis points and no asset liability mismatch. And you figure out how to kind of build it. But I think the problem on the product development side is that most products that are developed in the space are developed by salespeople who think they can sell it over the next year or two. It's a hot area, and they're going to launch something where they think there might be incremental demand. And I compare that to the hedge fund industry. If I back to Dan's article, is that generally when hedge funds launch new products, because there's a great investment opportunity, they're going to buy real estate in Greenland, something else.
Don't do that.
Denominated in Bitcoin. But they think there's something real there, and they're going to put their own money behind it, and they want to do it. It's completely backwards in the liquid alts world, in that the guys who are building the products are the equivalent of the salesman on the showroom floor, like designing a car for you because he thinks you'll buy it. And if it's a lousy car in 3 years, it's not his issue. And so it kind of dovetails with this thing about, should CTA managers be making changes to their portfolio models to maximize their risk-adjusted returns over the next 5 years, things that they have high conviction in? Or should they be responding to fears about clients about that, that once a year whipsaw that everyone runs into?
I mean, I have I have some thoughts, but I wanna hear Tom first. But by the way, I will say I have noticed on your LinkedIn post, Andrew, that you're certainly not shy of calling out some of your competitors. Let's put it that way. But I'm going to defer.
Someone asked you, for God's sakes.
I'm going to defer to Tom first.
Well, we live in a world where Simpsons episodes seem to have predicted most of modern life. And Andrew, I think there is a Simpsons episode where Homer designs a car from the showroom, which then bankrupts the company. So I think your analogy is quite interesting and quite correct. There definitely seems to be some sort of disconnect. My worry in the liquid alts data is, and it was something that I came across yesterday in a discussion, was the classification is the key thing. And are we talking about real hedge funds in that data, or are we talking about quasi alternatives that live in this semi-alternative world where it's kind of multi-asset but being described because it's a bit of a hot topic or sexy as multi-strat or macro, when actually it's just a kind of a GTAA kind of tactical asset allocation across multiple different asset classes. The conversation I had yesterday was with someone who was interested in quant multi-strat UCITS funds and was telling me that there was a universe of 100 of these funds, and I struggled to name even two. So I think there's a disconnect in what liquid alternatives is, and what may be represented there isn't necessarily hedge fund strategies all the time. But I think you're definitely right. There's definitely a mismatch or a misalignment between what hedge funds are creating as product and what an investor can satisfy their investment committee with. It goes back to what we were talking about earlier about, has the hedge fund industry improved? You're always going to get this sort of different areas within the hedge fund industry where you've got strategies that become scalable, that form part of a larger, longer term tactical asset allocation that you want to have as a core holding, like a CTA, and then pure alpha, where you're going to have strategies that come in and out of vogue. Maybe it's multi-strat at the moment, a huge amount of interest in commodity hedge funds at the moment. These were commodities was nowhere 5 to 10 years ago. But now suddenly it's very, very interesting. So there seems to be this kind of split in two within the hedge fund industry of, as I sort of said, this sort of niche alphas and things that form part of a larger tactical asset allocation, which obviously are going to then have costs come down, and there are going to be periods when they underperform. But you've got to remember, we're living through an unbelievable equity bull cycle, which shows no sign of abating.
Well, okay. I mean, to address your point. So on the data side, you can look at the data in a lot of different ways. It sucks. Okay. I mean, the performance across the board is terrible. And this is one of those areas where they ended up alienating a lot of people, because people make money on products that scale up to a couple $2 billion. And then they've got to, you have 5 products. One of them has a couple of good years of returns. You send an army of salespeople out to sell it. It scales up to $3 billion. And then it just kind of whittles down over time. And clients end up often not making money. So, I mean, look, you can look at the multi-strat, the multi-manager, mutual fund and ETF, so mutual fund and UCITS category. Like even Blackstone gave up on that. I mean, Neuberger Berman shut down their fund. Like it was a failed business model. That is, now there are some funds in it like Blackstone's BIMBX, which has done a bit better. But again, that's more of kind of a quant multi-strat product. I mean, it was interesting. So, I mean, I went to speak at EQ Derivatives a couple of weeks ago with the whole QIS risk premia space. And one of the observations that I had about it is that people really don't talk much about returns. They talk about modeling and research and data and innovations and all these other things. And I kept asking these questions like, what's the realized Sharpe ratio of the strategy for over what period of time? And what do you think it's going to be going forward, and why? But going back to the point about that is a different example on the product development side, where products are created there because there's an audience that wants to hear, wants a pitch around engineering. A guy who I know is quite a serious allocator, he said, look, if I had to rank the single most successful allocator to the CTA space over the past 10 years, it's DBI. But and not by investing in funds and not by picking managers, but by saying, what's the signal here? What is it we're really trying to get, and how do we do that as efficiently as possible? And so I think the challenge is the test for people on the allocation side is to get very, very clear about what you're expecting a product to do and how you're expecting to achieve it, and to understand how to evaluate that and how realistic it is for them to achieve those goals. And so back to Niels's point, I often call out people where I think they don't have a strong view as to whether this is a good idea or not, but they sure have a good idea that it's good for them to launch a new product. and I just think it's bad for investors. So, obviously, I feel strongly about.
No, I mean, this is a great thing about this. We can have these pretty frank discussions. I mean, I think we could probably say with most firms, when you launch a product, a certain narrative goes with it. I certainly remember your narrative, Andrew, when you launched your product, right? Focused on kind of the cost saving in order to get exposure to CTA returns. But when I look at it, if I'm being very frank about it, I look at your product, actually, the more I look at it, the more I look at it differently, that it's actually not about the cost savings. Because I feel at least that the tracking error to the index that it's trying to mirror is too large for that. So I see it more as an alternative data strategy where you just use a different data set input and it has worked really well in that sense. But of course, even 5 or 10 years worth of data, we don't know what the next 10 or 20 years is going to be like. And I completely agree with you, by the way, that there is a lot of products that really shouldn't be launched, and it's not good for investors to come out there, right? But I also, from having seen this space from the inside for quite a few decades, some of these things would just go in and out of favor. And even if you have 5 years of underperformance, doesn't mean the next 5 years, the next 10 years won't, you're going to be the highest performer. It's really hard to tell.
But I mean, things that I try to highlight are when it's predictable on the front end, right? So Standard Life GARS, okay, I learned about Standard Life GARS in 2015 for the first time. They were out telling everybody that largely a long only, but also with derivatives built into it, multi-asset portfolio could deliver a beta of 0.2 to equities and cash plus 5. Okay. That's a top quartile, maybe a top decile hedge fund portfolio over time. Okay. It's not realistic. Okay. It was never realistic. It was, we happen to have done that because we flipped heads but again, it went to $90 billion, this thing. It was bigger than Bridgewater at its peak. And so I talked about it at the time and I said, you're kidding yourself. If you're going to do a beta, like once you start talking about a beta 0.2, unless you start bringing in things that are quite interesting, like CTAs and CTAs before fees, before reducing your trading costs, unless you can bring in something like that, the reduction to beta of 0.2 is also going to kill your return profile. The same thing with the multi-manager funds. I wrote a paper in 2013 basically saying a mutual fund that tries to pick 6 underlying hedge fund managers and hires them in managed accounts is not going to achieve the return objectives that people were talking about at the time. I said the same thing about risk premia in 2014. G10 currency carry does not have a long-term Sharpe ratio 1.2. I'm sorry, that's a back test. Okay. And now I think people have realized the drop off between the back tested numbers and the live numbers is something like 75% or something. Equity long short as a category, if you have a beta of 0.5 or 0.4 to equities, it's not going to, the amount of stock selection alpha and other things you need to do to be able to overcome even the cost of a mutual fund or doing it is you're likely not to generate much alpha. So I think the allocator community is getting smarter every year about a lot of these points. But I think that there are things that work better on it. And the structural problem that you have is most liquid alternative products are sold, not bought. Capital tends to go to the largest firms with the largest salespeople who already have people who are invested in multiple products under the same umbrella. And it's an incremental addition to their portfolio. And the typical allocator does not, like, again, going back to this being a human exercise, doesn't want to ask the kinds of questions that I'm known for asking. It's, I just did a post on somebody who launched a CTA product with a team of people who, as far as I can tell, have never run a CTA program. Okay. So that is taking a flyer. They had basically $300 million of their client capital go into it. Now, if it works, if they get lucky, it's great. They have a $300 million product that's done really, really well. If it goes badly, it's their client issue and they won't talk about it. And 3 years from now, maybe they'll shut it down or something like that. I'm going to keep calling out things in this industry where I think that people who are standing there waving a fiduciary flag are not acting in the best interest of their clients.
It's interesting you say, do you think these products are sold and not bought? I was just looking at my screen trying to see if I can get the flow information on DBMF, because I'd be interested to know how do you have clients actively coming in and out, or is it of your funds, or is it more of a very long-term allocation part of the portfolio?
The vast, so I can't really talk about DBMF for compliance reasons, but I'll give you sort of generalizations in terms of, so I wrote the business plan for DBMF in 2016. And what it was based on were conversations with allocators who were looking for ways to get exposure to this space, but had three issues that they were dealing with. One was a line item constraint. So if I talk to Cambridge Associates or Mercer or somebody else, they can populate an institutional portfolio with 4 funds and get some measure of diversification. The reason AQR went to 14 billion in assets in their mutual fund was because a lot of allocators were basically saying, it's AQR, A, it's AQR, what can go wrong? And B, I want to do a 5% allocation space. I guess it's the easiest thing is just to give it to AQR. Okay, that was a catastrophically bad decision. Not because, AQR is an absolutely staggeringly incredible firm, but they were taking idiosyncratic manager risk without understanding it. So what I thought was that there would be demand for something that would allow a model allocator who's not the fund selector, who wants to be in the business of deciding whether it's Niels or somebody else, and how to assemble that portfolio, but rather for somebody overlooking the whole portfolio, saying, give me as consistent and straightforward exposure as you can to this area in a reasonably priced way. So 85 basis points for ETFs was about half of what the mutual funds were at the time. And also, and ETFs were a growing vehicle in terms of popularity. And so again, we built it on the basis of feedback from people who were the decision makers to how to make it better. So back to your point, the vast majority of the capital are model allocators who there is somebody there who has a series of models for high net worth clients, or mass affluent clients, who is trying to, it's usually not a single allocation, but usually it's a core allocation or a within that bucket. So it's not actively, very few allocators actively trade, which they should. I tell them, if you're going to actively trade, you should find something else to trade.
SG has a very active and a very diverse and comprehensive QIS business. And I feel that the way those products are used and the way those products are approached by clients is probably more in line with how you describe your client journey, but it's a client engaging and trying to get exposure to a specific asset class or strategy or theme. So there seems to be very sort of thematic use of these QIS. And I was actually really surprised to hear that often we have global macro hedge funds who want to access some sort of curve steepener or some sort of thematic play for a finite period of time, who will use the QIS as a much simpler implementation of a macro theme.
I'm a huge fan of QIS when you know what you're doing, right? When you are trying to articulate a bet and you are outsourcing execution and financing and everything else to somebody who's in most cases is better situated to do it than, if you're not Two Sigma or DE Shaw or something who can do it themselves, presumably. No, it's rather, what I was referring to is back in 2013 was that the space was being marketed as having these liquid strategies that as having strategies that were sharp ratios that were unrealistic. And I think like even in the US, the use of indices within ETFs and structure and mutual funds and UCITS funds, it's going to be a hotbed of innovation, not just for capital efficiency, not just for trading efficiency, but also because it opens a different category of investors who is not going to buy a 150 or 160 basis point single manager mutual fund in what they do, because they have, low cost ETF model portfolios that require things that are look and feel more beta-like. So the product innovation is there. It's my criticism is that there are a lot of landmines in the space that have been predictable, and I've been talking about it for 15 years, right? So I think I am hoping that as, again, in terms of the investors that I talk to, they're really smart. Like I'll tell you, I started talking about an AI story, about an allocator who really knows what he's doing, and his clients are much better off for it. And the allocator base will continue to get more sophisticated. The same way the QS allocators are much more sophisticated than they were 12 or 13 years ago when I first talked to them about this space.
I don't know if this is completely hitting sort of this mark, but I'll venture it anyways. I mean, of course, we're going to have product innovation. I mean, you, Andrew, have been definitely a part of that revolution and disrupting the space. And my concerns with things like QIS is that, yeah, we know it's there, we know it's huge. We have no transparency. We have no idea what the returns actually are compared to, quote unquote, if they're trying to replicate trend following or replicate CTAs or whatever. But we don't really know how they're doing because they don't publish their returns or anything like that. I guess my concern, and I do know this sounds really old-fashioned when I say it, right? But it's great with innovation. But I am still concerned that when you come at the problem, when you come at something and say, yeah, we can give you that, right? We can give you the CTA returns, or we can give you trend following, low cost, and we'll do it completely differently. But often over time, when you do things really differently, why would you expect to be able to deliver the same outcome? And maybe we have not seen it yet, right? Maybe the way markets have behaved. I noticed both Katie and Nick had some analysis where the environment for managers had been in a certain way the last 10 years, but it was completely opposite almost in the first 10 years of this millennium. And so all I'm just saying is, I'm open to surprise both ways, in a sense that, yes, there's going to be periods where these innovative structures outperform and do really well. And it kind of looks like, oh, we've solved it. There's another easy way to do trend following without you having to do all the nitty-gritty stuff that we do and have done in the last 50 years. But hey, at some point, maybe we realize that, okay, it works, but it doesn't work all the time. And that's just my expectation to this space. But I do agree that firms should not knowingly move into this space without the right experience and just, if they can, put investors into products that are not as they build as they should.
Can I comment? So one of the when I first looked at trend following models back in, and these are the bank trend following models, and it is easier to get the information now than it used to be. When I first looked at the space, I was asking questions that other people weren't asking, which was, okay, when did you actually launch this index? Right? If you launched the index 3 weeks ago, then have you launched other indices that look like this? How did those do? Right? So these are normal due diligence questions. The fascinating thing about it was that I think a lot of allocators just sort of suspended belief and decided not to ask those questions because they were under so much pressure to find liquid, investable ways of getting things that had low correlation to equities. But that's a different story. My issue also was calling it a risk premia, right? So labeling trend a risk premia, like as Tom knows, their trend indicator can look very different than the SocGen CTA index, can look very different than the SocGen CTA trend index can. And so risk premia implies that if the three of us design it, it's going to look the same. Like maybe it's not the S&P 500, but it's going to be within kind of and I think that's been a narrative. The narrative history behind that was after the quants almost blew up in 2007. And before that, they were saying, basically we're quantitative long short order based black boxes and we're going to generate alpha from scratch. And it was like, oh my God, this is almost long-term capital, second time. And so, with starting with AQR and others, the narrative on the space shifted to, no, we're just harvesting risk premia that have been around for 70 years. And these are permanent features of the market. And so, BlackRock and AQR and others who jumped into this space talked about this as, it's not risky. These are just permanent features of the market, and we're just going to help you to access it in an efficient way. That I think was wrong. So when I wrote about the trend, and I wrote a paper on the trend products, we know that manager risk, as we talk about, is very, very high in this space. The three of us design a model, a long-term trend model. We may have a correlation of 0.8. We can still be 20 points apart at the end of the year, right? But it was the characterization of it as risk premia implied that XYZ Bank's solution would be the easy one-stop solution. Now, the way sophisticated allocators have adapted to this is not only by going underneath the hood on all these products to a great degree, but also thinking about, okay, so this is your flavor, this is another bank's flavor, and this is another bank's flavor. How, as an investor, how as an allocator, do I want to put these together into a package, thereby becoming almost like an outsourced portfolio manager? And again, I think that's an enormous improvement relative to where we were 12 or 15 years ago. But then people can make they can make calls. And do we think the team here, who has 37 other quant projects that they're working on, do we think these are the people that we really want to invest in to be able to build this particular product, or do we want specialized expertise?
Yeah. I mean, with all models, whether it's CTA models, replication models, or whatever, I mean, there is a model risk somewhere, or an execution risk, or whatever that might be. But yeah, this was great. We certainly got around today. Tom, and Andrew, any final thoughts before we wrap up?
I hope this is the trendiest year we've ever seen.
So do I. What about you, Tom?
Well, yeah, it's something that seems to happen here. We touched on the global kind of conferences, and it's every year we seem to enter. The first half of the year seems to go off with a bang, and I agree with Andrew. We want those trends to persist, and we want to have good volatility, but not bad volatility.
Yeah. I mean, I think we didn't even touch that much on it, but we had written it down that we would talk a little bit more about global macro and all of that stuff. But I think we can all agree that there are a lot of things going on in the world right now. So if you are, if you are engaged with strategies that essentially not trying to predict too much about where things are going to go, but do enjoy change as a return driver, then yeah, maybe this could be a good year for us. Anyways, Tom, I look forward to seeing you in Miami in a couple of weeks. Andrew, I look forward to seeing you in a few weeks back virtually here. Now, for those listening, if you want to show your appreciation for Tom and Andrew for all the work they put in these conversations, go to your favorite podcast platform and leave a rating and review. It does really help us, and it's nice to show some appreciation for all the co-hosts who put a lot of time into producing these episodes. Next week, Alan will take over hosting for a couple of weeks while I travel. He's going to be joined by Mark one week. He's going to be joined by Jim another week. So please make sure to send your questions to info@toptradersunplugged.com, and I'll make sure that Alan gets hold of them. From Andrew, Tom, and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, as always, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.